The debt paradox: why perfect people have bad scores. Imagine a person who lives with perfect financial discipline. They have never borrowed a single dollar. Every bill is settled on time without fail. No outstanding loans, no mortgages, no credit cards. To the ordinary observer, this individual represents the pinnacle of fiscal responsibility. You might naturally assume they would have a flawless credit score. Yet, in modern finance, the opposite is often true. This surprising situation is known as the debt paradox, a quiet, almost invisible trap. It ensnares many honest, hardworking people, preventing access to the most favorable loans and the lowest interest rates when they finally need them. The anatomy of a score: beyond paying on time. A credit score is a three-digit number that holds immense power over your financial life. Lenders use this single figure to make rapid judgments about your reliability as a borrower. Lower interest rates, better loan terms, greater access to financial products. It is a complex composite, a weighted average derived from 5 distinct categories of your financial behavior. The secret mathematics are governed by the interplay of these 5 crucial factors. The most significant component, and the one most people are familiar with, is your payment history. This factor alone accounts for the largest portion of your score. A consistent record of making payments on time demonstrates reliability and significantly boosts your score. Conversely, even a single missed or late payment can cause substantial and lasting damage. This is the foundation of creditworthiness. Lenders must have confidence that you will honor your agreements. Any deviation raises a red flag, suggesting a higher risk of default. However, payment history is only part of the story. The second most important factor is the total amount of money you owe, often referred to as your credit utilization, the length of your credit history, the pursuit of new credit, the mix of different credit types you use. While paying on time is critical, a high credit utilization ratio can pull down an otherwise healthy score. A very short credit history can also hurt. It is the subtle and often misunderstood influence of these other factors that creates the conditions for the debt paradox to emerge and flourish. Understanding these 5 pillars is essential for anyone seeking to master their financial destiny. The scoring models, such as FICO and VantageScore, analyze these elements to generate a predictive score. Payment history forms the bedrock. Your score is equally shaped by how much of your available credit you use and how long you have been a user of credit. The perils of perfection: credit utilization and history shadow. 2 of the 5 credit factors are particularly troublesome for the seemingly perfect consumer credit utilization: length of credit history. Credit utilization, the second most influential factor, measures the proportion of your available credit that you are currently using. It is calculated by dividing your total credit card balances by your total credit limits. For example, single card with a $2,000 limit and your statement closes with a $1,800 balance. Your utilization is a very high 90%. Credit scoring models interpret this as a sign of financial distress, suggesting you are heavily reliant on borrowed money. Even if you pay that balance in full after the statement date, the high utilization has already been reported to the credit bureaus. This is a critical point that many people miss. Your credit card issuer typically reports your balance to the credit bureaus once a month, usually on your statement closing date. This means that even if you are a responsible user who pays the entire balance each month, your credit report might still show a high balance. If you make a large purchase and wait for the bill to arrive before paying, your reported utilization for that month could be dangerously high, temporarily suppressing your score. To the scoring algorithm, a person who charges $900 on a $1,000 limit card and pays it off looks identical to someone who is carrying that $900 debt month to month, at least for that snapshot in time. The second major hurdle is the length of your credit history. This factor considers the average age of all your credit accounts, as well as the age of your oldest account. A longer history provides more data for lenders to assess your long-term behavior, making you appear as a more stable and predictable risk. This is where the debt-free individual is at a complete disadvantage, as their history is non-existent. It is also where well-intentioned people make a common mistake: closing old, unused credit cards. Closing an old account can have a doubly negative effect. It removes a seasoned account from your report and it reduces your total available credit, which can cause your utilization ratio to spike. To truly grasp the debt paradox, one must step inside the world of a lender and understand their perspective. So bear with me. Banks and credit card companies are not charities. They are for-profit businesses. Their primary method of generating revenue from credit cards is through interest charges on revolving balances, merchant transaction fees. From this purely economic standpoint, the ideal customer is one who borrows money, carries a balance from month to month, reliably pays the minimum amount due, thereby maximizing the interest income for the bank. This customer is profitable. Now, consider the customer who pays their balance in full every single month. These individuals are often referred to within the industry as deadbeats or transactors. This term is not a moral judgment, but a financial one. These customers use the credit card for its convenience, security, rewards points, but they contribute little to no interest revenue to the bank's bottom line. While the bank still earns a small percentage from the merchant fee on each transaction, this income is far less substantial than the high-margin interest payments collected from revolving customers. This type of flawless financial behavior, while admirable, makes for a less profitable relationship for the lender. This difference in profitability can lead to subtle but impactful actions from the bank. A lender may be less inclined to offer large credit limit increases to a customer who never carries a balance, as there is little incentive to extend more credit that will likely not generate interest. If a card remains completely inactive or is only used for very small purchases, a bank may reduce the credit limit or close the account altogether due to inactivity. This is done to manage the bank's own risk exposure and reallocate that available credit to potentially more profitable customers. When a bank lowers your limit or closes an old account, it directly damages two key components of your credit score: credit utilization ratio, average age of accounts. So the very act of being a perfect non-interest paying customer can trigger actions from your bank that actively harm your credit score. You are, in essence, being penalized for your own financial prudence, caught in a system that is optimized for and rewards a different kind of behavior: the consistent, profitable management of debt. Escaping the debt paradox does not require you to abandon your responsible financial habits. It simply requires you to understand the rules of the system and use them to your advantage. The first and most powerful technique is to master the 10% utilization rule. Aim to keep your reported balance on each credit card below 10% of its limit. This does not mean you should only spend that amount. It means you should ensure the balance is low when the issuer reports it to the bureaus. To achieve this, make a payment before your statement closing date. Example: card limit $5,000. You spend $2,000 during the month. Pay $1,800 before the statement closes. Reported balance $200. 4% utilization. The second strategy is the authorized user hack. Have a family member or trusted friend add you as an authorized user to share their long, well-managed history. Finally, never close old credit cards, especially no annual fee cards. Old open accounts lengthen your history and keep utilization low.